welcome to Bharata First. You're watching Big Picture with me, Frank Razan Pereira. Since you're here, let me ask you, have you liked the video and subscribed to Bharata First? If no, then please do so now. Do subscribe to our newsletter as well to get some incisive information. And how can I not tell you about the Bharata First Knowledge Center? It is your one-stop destination for all your competitive exams needs. We now have 26 amazing courses all put together to help you in your competitive exams and also make you better Bharatiyas. Live classes for the second phase have begun. Do ensure that you register now and participate in the interactive sessions. Go to kc.bharatafirst.com for more details. You can also download the Bharata First app and participate in all the activities that we have there. Currently, since we have received a silver button from YouTube and are extremely happy about achieving that feat, we would like to share our joy with you as well. And at the Knowledge Center, any one of the packages that you pick up, you will get at a heavily discounted price of just 5,000 rupees. So 26 courses, all available at less than 200 rupees per course at the Knowledge Center. Don't miss out on this incredible opportunity because we want to share our joy with you. And it is available only for the first 25 to register. So don't be left behind and don't regret later. Register now. All this information along with some must-see recommendations are in the description of the video. Please go through it. And now on to the discussion. The formation of a bad bank in India is likely to help reduce stress in the banking system and give an impetus to the credit cycle, according to an article in the Reserve Bank of India's February bulletin. The cross-country evidence, the RBI said, suggests that if the logistical and financial challenges are carefully navigated, experiments of such bad banks can have more hits than misses. It said that while some experts have hailed the formation of the National Asset Reconstruction Company Limited, or NARCL, as a panacea for all ills, others pointed out the existence of multiple avenues of stressed asset resolution and their challenges. The article draws lessons from other nations where bad banks were set up to predict if NARCL would be a success. In this edition of Big Picture, we will analyze the pros and cons of the proposed bad bank. Joining me on the program today are Professor Charan Singh, CEO, EGROW Foundation. Also with me on the program, Vineeta Hariharan, public policy expert, and Subhomoy Bhattacharjee, consulting editor of the Business Standard. Professor, let me start the program with you first. Let's first understand, the concept of bad bank. What is a bad bank and how will it help?
Thank you so much. This is a concept which has been in the air for quite a few years, I would say. And of course, it has been there in the Western world for a longer time. Though it's called a bad bank, but I think it's a good idea. They should actually call it a good bank. Why it's called a bad bank is because all the non-performing assets of the existing commercial banks are poured into this bank. And then it is this bank's responsibility to sell it as and when it can and survive. But then it also helps to clean the balance sheet of the commercial banks. Now, as you know, the banking business, since times immemorial, has lots of risk. And because it has lots of risk, some of the assets do go bad. So they become the non-performing assets. On an average, globally, 1 to 2% of assets going bad is an accepted norm. But then during times of crisis, and this has happened especially after the 2008 global financial crisis, the assets have been going bad and sometimes ranging even in our own country. The net performing assets and the gross non-performing assets have been rising rapidly at 1.8%. Now, how does a bank function when you are carrying so much of baggage on bad loans on your portfolio? Now, as a commercial bank, you are being assessed, rating agencies are assessing you, the market is assessing you, your share values fluctuate. All these things get critically evaluated when you have bad non-performing loans on your portfolio. You also need to build reserves for that non-performing loans. It is also a big drag on the morale of the people who are working in the bank, as well as your reputation in the market takes a hit. Keeping all these things in mind, looking at the business model, many countries in the world and India now is thinking of setting up a bank where you can just skim the bad assets, non-performing assets, at a severe high haircut. So that is one of the big drawbacks, at a severely high haircut. So you do incur a massive hit on your balance sheet, but then you can at least start doing the functions again. So it is something like forgive and forget. I must mention that once you give it to the bad bank, it's not that then everything is over. They give you some value right away, but then there's an understanding that as the values get realized by the bad bank, you still get something more out of it. So in a nutshell, I would say the idea is good. The time has come. It is a universally accepted norm, and therefore India is in the right direction in accepting this.
Absolutely. All right. Points well taken. So we've gotten to why we need such a bank. Vineeta Hariharan, how will this bank really work? How is the proposed bank going to help?
Yes, thank you, Frank, for having me here and to carry forward what Professor Charan just mentioned. So a bad bank is actually a bank that absorbs the bad loans, so to speak, of the banks. So that's why it's called a bad bank. So it's a tried and tested formula which has been adopted by especially the Southeast Asian countries. So to mention the specific cases of Malaysia and Korea, which they've successfully been implemented in these countries to take over their bad assets. So that has been done way back in both the countries. One in Malaysia, it was the Dana Harta, and in Korea, the Korea Asset Management Company. So both of them were successfully done to take away the bad assets of the banks. So just as the professor mentioned, it takes away the it increases the bandwidth of the bank, so to speak, in layman terms, to focus on other productive functions of the bank, especially to carry forward various flagship programs and also to reach out to the people in terms of the outreach. So they're not burdened by the non-performing assets, because many of the banks always complain that, in the mudra loans or of the other loans, they're not able to really kind of pass it on because they're really burdened by the NPAs. So a concept of a bad bank could actually, it could hive off all these burdens of the banks and would actually take care of and also kind of adopt innovative methods to sell these loans and recover the assets. In both the cases of Malaysia and Korea, I would say it was not 100% recovery, but at least around 50 to 60% of the bad loans were recovered in both these countries. And to talk of our own country, we have about 15% of the advances, which figures speak of 15 lakh crores of non-performing assets. And also, if you look at the NBFCs, if you add the NBFCs, it would be around 3.5 lakh crore added to these NPAs. So therefore, it's a huge case to be dealt with. Although the Insolvency and Bankruptcy Code infrastructure that was launched in 2016 was there to resolve this, but then it's taking a lot of time. So the IBC infrastructure alone would not help in resolving this crisis entirely. Therefore, the need for a specific vehicle, which is this bad bank.
Absolutely. Since we are here, Subhomoy, let me just build on that point that Vineeta just made and take that forward with you. The NPA problem has been a big Achilles heel as far as banks are concerned, and the government has taken many measures to try and address it, but it hasn't been as successful as we would have thought it out to be. So the bank, is it going to address the primary issue of NPAs at the core, and how well can it do it?
That's an interesting point. On NPAs, I think, of course, these are cyclical, so they do. I mean, you do need to think about it. But if I look at the budget this year, the government hasn't had to provide any additional capital to banks for fiscal 23, which means that the banks now feel that they are comfortable enough not to need any. This is the state-owned banks need any additional support. Even for last year, the current year's 20,000 crore, 15,000 crore is what has been spent. So essentially, we do seem to have reached some measure of stability on the NPA front. The banks have been able to recognize most of what they had on their books, and they have provision for it. They don't need any further taxpayers' money. So that's something to feel comfortable about. I quite take on board what Dr. Singh and Dr. Hariharan said about the issues about the bad bank and why the bad banks are necessary. and I'm fully on board with them. My concern is about the fact that whenever we are doing all this thing, it's about the state-run entities. And there, I was just wondering whether bad bank is the answer, or whether whether we are taking a more costly answer instead of answering something which is more obvious, which is like, let the shareholders decide. For instance, if a bank today, if a private sector bank gets into problem, then what happens is that the bank's management takes the rap. The shareholders punish it by pulling the bank's value down. The bank therefore goes into correction mode. I'm not saying that the bank gets closed down, but lots of things happen before the general public has to pitch in to save the bank. What happens is, and I'm saying even despite the example of Yes Bank, where you'd see that it's actually the correction happened much better. In the case of a state-run bank, since it is the government which will be doing it, the banks will be able to get away by sparking a bad asset with the bad bank, or a good bank, as Dr. Singh pointed out, without having to make the correction. But that is in the sense that who takes the rap? Should the taxpayer be taking the rap before the shareholders do? The shareholders would to some extent, but it will not be the bank's price will not really correct to the extent that it would have for a private bank because of the sovereign guarantee that the government gives. So that is where one concerns. I would expect that, bad bank is a great idea, but if along with the bad bank, we simultaneously proceed with a rapid cutting down of the government's shareholding in these banks, then that is a very good solution. Keeping the crutch available means obviously the bank will reach for the crutch first before making the management pay for the sins. Whether it's an obvious omission or whether it's a deliberate willful default, whichever way you look at it.
Absolutely. That's a very interesting point that Subhomoy has raised.
We are happy to receive our silver button, and we would like to share our joy with you. To celebrate this feat, we are giving away something amazing to our lucky learners at the Bharata First Knowledge Center. The first 25 to register will get a platinum package of 26 courses at just 5,000 rupees. So what are you waiting for? Register now at kc.bharatafirst.com or download the Bharata First app. Happy learning.
Professor, I'd like to take that up with you, and also add a point here about the bad bank itself, and what kind of a guarantee or can we expect really as far as the government is concerned with regards to the bad bank? Unmute, please.
See, I think a very valid point has been raised, and that point has been in existence for a long time. Look, the concept is, if you have insurance, then do you do reckless driving? Now, that is true. Once you have a huge insurance cover and that medical will be taken care, why not try and experiment and do reckless driving? So in the economic literature, that issue has been discussed on and off. Now, once there's a bad bank, and therefore you will be able to skim off all your bad assets, then why not be reckless, and why not really cover all the risk management, and why not do the KYC properly? I totally agree with that. And therefore, in a way, this is one of the fears that can come in. The other point, and that's the negative side, it's totally recognized. But the other point which I want to mention is that when you are in India, especially in the current phase, when you are a public sector bank, you have lots of social responsibility, you have lots of funds on you, and you have such a wider outreach across the country, then all the big infrastructure projects obviously come in your lap. Now, you have the funds, you have exciting infrastructure projects, you are a public sector, therefore you have a moral obligation as well to pursue the policies that the government is pursuing, and that the government is providing you support every now and then, helping you financial support, or even now setting up a bad bank and ensuring that your assets are clean. Now, in such a situation, it is obvious that the onus falls on your responsibility, on your shoulders. Now, when you have to do such huge financing of infrastructure and the economy starts sagging down, or the global economy starts sagging down and you're part of the global economy, this is bound to happen that your assets will go back. After all, banking is very much related to the corporate sector and to the business and environment around it. And the government influences it, the external sector, the external factors influence it. Now, given this scenario, obviously, then the insurance has to be done. Because then while you are in a way supporting the public policy of the government in a bigger way, and then you face a crisis of this dimension, then obviously insurance has to be provided. And that's exactly what the government is doing. I think the way they've done it, and then they've provided an guarantee to the extent of about 30,000, if I remember correctly, 30,000 crore, saying that, okay, you take in the plunge and we are here taking care of this. So to my mind, the concerns expressed are genuine, but that is part of economic literature and that can happen in real life, in personal life, as well as in banking, that is taken care. And the government providing a guarantee also ensures that the government is not just leaving this bad bank. And that is one of the logics that was extended. There are already asset management companies, asset reconstruction companies happening. Why did the government have to come in? And the way they came in, I thought they came in a very good, well-conceived way. They have the India Debt Resolution Company, which will be starting to sell, and they also have the National Asset Reconstruction Company, which will be sort of procuring the bad loans. So in a way, I think the government is seized of this issue, aware of this issue. The last point I want to make, Frank, I'm sorry it's gone a little long. The last point I want to make is that I have myself been as a chairman of a commercial bank, and I can tell you firsthand the hand-holding, the guidance, both from the government and the RBI through their letters, communication, their publications, their circulars, their all the material that you have, their speeches, they meet the MDs regularly, is that they try to make sure that your assets don't go bad. So recklessness to that extent is taken care of. Guidance is also provided. So therefore, they are not like loose horses who would recklessly enter into a crisis. No, they're well controlled. The stables are secure. But the business model of banking is such that this can happen to ensure that the banks don't do lazy banking. They do take some risk. I think this serves as a very good platform as a backup.
Absolutely. Points taken. All right. So, Vineeta Hariharan, coming back to you now, let's talk about the kind of resolutions we can expect really as far as bad bank is concerned, because we've seen that the NPAs have come down from about 8.4 lakh crore rupees from 2020 to about 7.8 lakh crore rupees in 2021. So that's a good decline really, but there are two main factors for that. One is the post-COVID moratorium as well as the recoveries. So when we look at some of these NPAs and when we look at some of these recoveries to be made, what is the kind of resolution that we can expect?
Yeah, absolutely. So as the earlier panelists, Professor and Subhomoy just mentioned, a bad bank actually takes away a whole lot of burden from the banks. Therefore, the resolutions expected the rate of resolutions would definitely increase. And also, I think talking of the concept of the moral hazard, which both the panelists spoke about, it does not mean that a bad bank, once you have a bad bank, the banks think that, okay, they can do whatever, they can do reckless lending and hive off the NPAs to the bad bank. So I think there needs to be a graded response, and there needs to be classifications of bad loans as well, I think. So the ones that are totally in the red only need to be taken to the bad bank, so that there is some performance measurement for the banks per se, and not that they hive off everything to the bad bank. And so there needs to be checks and balances, and I'm sure the RBI and the government would work out the nitty-gritties of the functioning of this bad bank and how much of the NPA should actually be hived off to the bad bank. So I think taking care of all these measures, I think the bad bank is a very good concept, and it could lead to larger resolutions of these loans. Taking the examples of case studies of Malaysia and Korea, I think it's a heartening, examples. And so we can take confidence from that and go forward. I think it's better late than never. We're always late in coming out with these reforms, whereas neighboring countries have done this long back. So I think it is time that we go forward with global best practices and go forward with these practices.
Points well noted, absolutely. So let's take the discussion forward now. Subhomoy, let me bring you in once again. And what are some of the other areas of concern really as far as bad banks are concerned for you? How do we address them?
One of the things that I would say is taking on from what Ray was pointing out, if we are going to do this reform, then one of the reforms that will definitely be needed is that there should be, first of all, better recognition of bad loans. Before RBI Governor Urjit Patel left, he had put in a circular, which came to be known as the February Circular, that even a single day's delay in servicing a loan should lead to recognition of a bad loan. I'm not saying that we go exactly there, but RBI should now insist for more stricter provisioning. They already have, but now there's no reason, if the banks are going to be able to park their bad loans with the bad bank, then fair enough. Then the loan recognition should be faster. That's one thing. That'll make the markets feel more comfortable. That yes, the loan recognition is, there's no particularly perpetuation of a bad habit along with shouldn't be necessary. The second part is, the gripe among most bankers is that they are scared of giving credit because of the CVC, CAG, combined, CBI. Now if that is the case, if there's going to be a bad bank, now, by definition, if a loan has gone to a bad bank, then that loan is obviously not a willful default. It is a genuine loan which has gone sour. If that is the case, then it should be made mandatory. And I think some law should be, some regulation should be brought in, doesn't need a law, that those loans, if CVC, one of those guys have tried to bring in a, case or charge a banker, then that should immediately be resolved. Because obviously you cannot have, it's absolutely illogical. You are saying that this is a genuine loan which has gone bad, so I'm shifting it to a bad bank. Then why should the government's vigilance agencies be chasing the banker against those same loans? That actually I think will be a very salutary, because this will give banks confidence that yes, if a bank loan is good enough to go to a bad bank for being sold in the market ultimately, then obviously it was a genuine loan which, because of market changes, adverse economic conditions, went bad, which does happen. So I think that will give a lot of faith to the bankers. I think if we're going to have the bad bank, and we are going to have it, we should make this change to ensure that the government's vigilance rules change drastically on this particular account.
Absolutely. All right.
We are happy to receive our silver button, and we would like to share our joy with you. To celebrate this feat, we are giving away something amazing to our lucky learners at the Bharata First Knowledge Center. The first 25 to register will get a platinum package of 26 courses at just 5,000 rupees. So what are you waiting for? Register now at kc.bharatafirst.com or download the Bharata First app. Happy learning!
It's time to get quick closing comments now from all my panelists with the best way forward, starting first with you, Professor Charan Singh.
So I would say this is a very good idea, needs to be done, not only Malaysia and Indonesia, but countries like Ireland, Spain, Sweden, they have also experimented with it. So it is something which is universally accepted, and there's empirical evidence that it is useful. I also feel that yes, the pressure on the banker is very high, and that the fear of vigilance coming on to them is also very high, that in a way restricts and curbs. And this sort of an initiative, which has global empirical evidence, is being experimented. But I think one should go ahead with it.
Absolutely. Vineeta Hariharan.
Absolutely. So I agree with Dr. Charan Singh when he mentions about the global best practices other than the Southeast Asian examples. And so taking from that, and bad banks should be across the public and the private sector. So, and also keeping in place checks and balances so that we overcome the risk of moral hazards by the bank. So I think we should go forward and do it on a fast track basis, and also perhaps also look at implementing digital platforms like Threads, etc., and how we could integrate that with bad banks. So I think so way forward to way to go, but to be fast tracked and implemented in a way that it is not really leading to greater risk management issues.
Absolutely. And Subhomoy, close the show for us with your concluding remarks.
Since we've got this now, the new avatar on the road, so let's use the best available opportunities, bright ideas that can come from different places. We should use that. The bad bank shouldn't just be a place for hiding the bad deeds of the banks. It should be a place to actually demonstrate that there is possibilities. In fact, one of the big advantage of a bad bank can be a lot of assets which don't get monetized. Land, for instance, can automatically come into play. Manufacturers talk about the shortage of land that they have. A manufacturing unit sitting idle is actually sitting on a land. So there's lots of those advantages that would come. So yeah, I'm hopeful about this particular resolution plan. And let's give it a couple of years to follow through and to see the results that are coming up before we take a further check on it.
Absolutely. Yes. All right. We'll have to leave to that. Thank you to all my guests for joining me on the program and putting things into perspective for us. Well, what's coming out of this discussion is that the idea of a bad bank is a good one, and it has come at the right time. There are challenges that need to be addressed to make it work, however. With the bad bank coming in, the other bank's risk management may take a hit. The bad bank is like an insurance policy, but should not be taken for granted. The concept that worked in countries like Malaysia, Korea, Sweden, Ireland, and Spain, we have to focus on taking the best practices forward from there. Currently, the pressure on bankers is very high. The bad bank will reduce those troubles for bankers. What we need to focus on is having the right kind of checks and balances and fast track the process of resolution. Now, before I go, let me once again remind you to like the video, subscribe, hit the bell icon, and share the content too. Do subscribe to our newsletter to get some incisive information. And how can I not tell you about the Bharata First Knowledge Center, our big success story, which is your one-stop destination for all your competitive exams needs. We now have 26 amazing courses all put together to help you in your competitive exams and also make you better Bharatiyas. Live classes for the second phase have begun. Do ensure that you register now and participate in the interactive sessions. We also have a sale going on at the moment because we have received our silver button from YouTube and are very happy about this feat. So we would like to share our joy with you by giving a massive discount at the Knowledge Center. And 26 courses are all available at 5,000 rupees for the entire package. This offer is there on other packages as well. So technically, each one of those courses that we have, 26 courses that we have, will work up to less than 200 rupees per course. So don't wait any further. Ensure that you go to kc.bharatafirst.com and register now for all the details, and ensure that you don't miss out on this incredible offer that we have, because it is available only for the first 25 people to register. You can also download the Bharata First app and take part in all the free activities that we have there. All this information along with some must-see recommendations are in the description of the video. Please go through it. That's it from me. See you again next time.